Greetings and welcome to this edition of In the Loop. In this educational update, we're going to talk about pasture, rangeland, and forage rainfall index policies, or better known as PRF. You ask, what is a PRF policy? The Risk Management Agency's pasture, rangeland, forage policy is designed to provide insurance coverage on pasture, rangeland, or forage acres. The PRF program utilizes a rainfall index to determine precipitation for coverage purposes and does not measure production or loss of production themselves. The rainfall index uses NOAA data, which utilizes a grid system approximately 17 miles by 17 miles. Acreage is then assigned to one or more grids based on the location to be insured. The pasture, rangeland, and forage insurance was designed to help protect the producer's operation from the risk of forage loss due to lack of precipitation. It is not designed to insure against ongoing or severe drought, as coverage is based on precipitation expected during the specific intervals only. How many types of policies are available? Well, there's two. We have a grazing option and a hay option. Grazing is approximately one half the cost of hay. See your producer print 578 to identify if they have it listed as hay or grazing. Note, they can change the FSA certification to meet the needs and to match what you want on your policy. But just be sure to make sure that you're not enrolled in any FSA or NRC type programs that might dictate a different type use for your land. As I mentioned, rainfall is collected through NOAA sites scattered across the United States. The map on the left shows a series of NOAA locations in North Carolina. The map on the right actually shows four locations, which are designated by the red X, and the blue pinpoint is Kenansville, North Carolina, in Duplin County. The grid that the blue pin mark is in Kenansville, the rainfall in that grid is actually measured by the four X marks, which are the closest locations to that grid. Some areas may have NOAA measurement stations closer to them, and some locations may have NOAA stations further away. Next, let's look at the RMA website and mess with the pasture, rangeland, and forage support tool. We'll walk through each function on that to help you better understand how the tool works. When you go to the USDA Risk Management Agency website, in the upper right-hand corner, type in pasture, rangeland, forage, and you will be directed to the page that you see on the screen now. Once you are there, go to the blue rainfall index towards the lower portion of the page and click the last line that says Grid ID Locator, Decision Support Tool, and Historical Indices. Once this site comes up, you will see a screen where you put in an address. What I will do for this example, I will put in the zip code 28349 for Kenansville, North Carolina. Once the address is entered and it comes up on the website, you can use your mouse to zoom in closer to the location which you selected. As we continue to zoom in here, you will get closer and the grid lines will start appearing on the map. Once this happens, if you look up in the top right hand corner, make sure you select grid lines, grid labels, county lines, and county labels. This will allow you to have a better understanding of which grid your operation falls in. Again, we're going to be using grid 17909 and this one, Kenansville, North Carolina. Once you do that, click the next tab, which says Historical Indexes. And what I encourage you to do is go down to the year range on the left-hand side under Historical Filter. And I like to filter out the last 5 years. So 18, 19, 20, 21, and 22 is what we'll be looking at. Some folks prefer to use 10 years, but I think over time our weather patterns change, and looking at a 5-year history document is much more accurate than looking at 10-year. The next thing we'll look at here, the next tab, is a decision support tool, and we'll look at this more in depth in a minute on another slide, but this is where you would select whether you will be using grazing or hay, and then you will select your intervals which you want to protect and insure. Now, to describe the interval deal, you'll notice everything is in 2-month intervals: January, February, March, April, and so on. You have to pick a minimum of 2 intervals. So if I picked January, February, and March, April, I would put 50% of coverage in one and 50% in the other. I could not pick January, February, and February, March. The intervals you pick cannot have the same month in 2 different intervals, as in January, February, March, both would contain the month February. What I've done here is took a screenshot of the screen we were looking at a while ago under historical indexes. And what I did, I took our 5-year range. And remember, we are selecting coverage at 90% of coverage. So any number here that would fall below the number 90, I have highlighted all the way across here for every set of intervals. When we look at this 5-year historical rainfall index here, any interval that fell below 90 I highlighted, and then I summed it up at the bottom. So this one is 2 out of 5 years you would have received an indemnity payment. This one, 3 out of 5, 3 out of 5, 3 out of 5, and then it carries on across. We had one here that was only one interval out of the 5 years that would have paid. It would have only paid in the year of 2021 for August and September. Now, based on what we saw in the last slide there, we have gone to the next one. We're going to give you a grazing example. We have selected a coverage level of 90%, which is the maximum coverage you can have. Our productivity factor, we selected 150%. I'll explain that a little bit further in a minute. When we look at the county-based value, the value for grazing in Duplin County is $52.90 per acre. But with the RMA allowing us to have a 150% productivity factor, we are allowed to insure up to $71.42 per acre here on our ground. And you remember I showed the number of years out of 5 that each interval would have paid. So I went in here and I split this example up into 4 25% intervals. I did February, March, April, May, July, August, and then November and December, placing 25% in each of the 4 because we have a total of 100%. So splitting it up by 4 means we had to put 25% in each of the areas. And what this does, it'll give us a summary. The producer premium on this one would average $5 per acre. And since this sample year right here was 2022, if we had picked these 4 intervals, the payout would have been a total of $18 for a $5 premium investment. We'll continue looking at this, and we'll look at the 5-year grazing example. We use the same intervals. This is just the last tab. Once you have everything entered on your decision support tool and it is calculated, you can go to this last tab and it will show you over a 5-year period where you would have received indemnity payments. Over here on the right, for sample purposes only, I've run this scenario, and as we said earlier, your premium for each year is going to average around $5 an acre. And when we look at 2022, it would have been an $18 indemnity, 2021, $16. Now, when we look at 2020, it looks like there would only have been a $3 indemnity for a $5 payment. Therefore, I highlighted it in red. When we look at 2019, a $5 premium with a $15 indemnity. And then when we look at 2018, another year that this policy would not have paid out beyond your premium. And again, folks, this is just an example for informational purposes only. We'll be glad to enter your grids and your intervals and look at the historic data specifically that will match up to your farm. To continue on with our example, we're going to do one for hay. In hay, you've got a couple other options here. Number one, irrigation practice. You can do non-irrigated or irrigated. Coverage level, I picked 90%. Productivity, 150%. Now you'll notice down here on your values, your county-based value is $250 an acre, but it allows you to insure over $340 an acre with this policy here by choosing the 150% productivity factor. For the example, I used the same intervals, the 4 intervals, and I put 25% coverage in each one. This gave us a premium of $18, and it looks like our indemnity would have been $86. And again, this is sample year 2022. And we'll do just like we did with the grazing example. We're going to look at a 5-year haying example. The same year span, 2018 to 2022. We used the same 4 intervals, broke it up. As we see here, our average premium is $18 across this 5 years. This may give or take a little in this grid depending on your exact location and the intervals you pick. Now, we're going to do them in order here from 2022 down to 18. This one looks like we had an $86 indemnity in 22, $74 indemnity in 21. 2020, one of those years in red, looks like that the premium was more than the indemnity paid out. In 2019, we had a $67 indemnity. And when we get to 2016, another year in red there, that the premium was $1 more than the indemnity that was paid out. And again, this is for educational and informational purposes only. This will be different when we run your grids with the intervals that you select based off the historical rainfall indexes in your area. And we will be glad to work with you, do a custom quote, get you familiar with how this works, and explain any questions that you may have. And that about wraps up this edition of In the Loop Educational Update. Today we touched on pasture, rangeland, and forage rainfall index or PRF policies. Whether you're just growing hay or whether you're grazing cattle, I think this policy will work for you. Give us a call. We'll come to you so you can focus on family and farming. And when we get there, we'll help explain this to you, find a solution that'll work for your operation and help protect your interest. Thank you for tuning in, and tune in again as we do other educational updates on our In the Loop. Have a good day.